Welcome to the Flathead Valley Real Estate Market Recap. Let's take a look at the August highlights. Residential, 1,015 active listings wrapped up the month, with 170 fresh properties making their debut on the market. Buyer interest remains steady, with 227 homes under contract and 164 successfully sold, landing at a median sale price of $657,000. 72 homes closed under $600,000. 51 homes sold in the $600,000 to $999,000 range. 41 luxury properties over $1 million found their new owners. Land. 627 parcels were available, offering buyers plenty of options to bring their vision of land ownership to life. August welcomed 100 new land listings, 33 went under contract, and 30 excited buyers celebrated their land purchase milestone. Commercial. 120 active listings rounded out the month, while 11 new commercial opportunities entered the scene. 5 deals are currently pending, and only 1 commercial property officially closed. Status update. 23 residential listings were withdrawn, 33 expired, and 51 were canceled. The month of August holds a total of 346 price-reduced residential properties that are currently on the market. As we close out August and enter September, the numbers have stayed nearly the same as last month. After the shifts we've recently seen, this leveling out offers a sense of stability, both for buyers and sellers.
Ryan, thank you so much for those numbers. Wait, you're not Ryan.
Nope.
This is Ed Nissen. Ed Nissen, welcome. We're so
Thank you,
happy to
my
have
friend.
you today. Yep, absolutely. I know Ryan gives some great numbers on the Flathead Valley, what's going on kind of in the real estate market on the housing part. However, we specifically have you here today, my friend, because you've been doing lending for quite some time. Tell us a little about yourself.
Yeah, you bet. Let's see. I've been a Montana resident over 30 years and lending for over 20 in the Flathead Valley. When I started to have kids, I had to find a job that paid me so I could pay for the mortgage.
Yep.
Yep.
What did you do before that?
Oh, I did all of the ski town jobs, carpenter, waiter, raft guide, ranger in the park, all the fun stuff for quite a while after college. Yeah.
Okay.
Yeah.
Good stuff.
Great memories.
Well, I specifically chose you because you've been helping so many of our clients and been one of our preferred lenders for years, which is fantastic. I mean, a lot of people on our team use you.
I appreciate that.
And you do it the right way.
I try hard at it. That's for sure.
Yeah. Well, experience tells, I mean, having you be in the Flathead Valley, seeing how things work, get creative with the lending, because sometimes Montana properties aren't as easy to finance. And I really like your truth, and I've dealt with some clients where it's like, sorry, we can't do that. But a lot of times it's like, let's get creative and find a way to do it. Yeah. And I think that's what I see in some lenders that it doesn't work, is that they don't really go the extra mile to find the solution. And thank you for doing that.
My pleasure. It's interesting with this market where rates are high, values are high, so obviously payments are high. And I feel like it's taken a lot more creativity in some situations to be able to figure out how to make it work for people.
Yep.
So in a way, this market has been a blessing for me because it's kept me busy, and you have too.
That's good. That's good. Perfect.
Yeah.
Well, I mean, I personally, I'm just like, I'm waiting for September 17th. I just feel like this is this exciting thing. It's like, oh my gosh, the Fed meeting, and everyone's talking about interest rates going down, and this fourth quarter and going to 2026 is going to be just gangbusters, which for real estate, of course, in my life is great. For your life, that's great as well. However, you and I were talking a little bit, like in the past couple weeks, about what's really actually happened and why. Because I saw a dip in interest rates a couple weeks ago, but the Fed hadn't met yet. So what does that actually mean?
Well, what I think a lot of people don't realize, there's a few things they don't realize, is number one, the Fed does not control mortgage rates directly. So that's they, in the news, people hear, oh, they lowered the rate, and the Fed lowers the federal funds rate, which often correlates to mortgage rates, but not always. Okay. So that's something. And the other thing people don't realize is that there's always economic news coming out every week that can affect mortgage rates. So the main one is inflation data, which is the PCE, personal consumption expenditure. or the CPI, which is Consumer Price Index. Those two pieces are measures of inflation, which is prices going higher. And when prices go higher, we have more inflation. That's really bad for mortgage rates.
Okay.
So we've had some positive pieces like that. The other thing that has helped mortgage rates as well recently is we've had some weakness in the jobs reports. And the reason that affects mortgage rates is the Fed has a dual mandate. They have to manage inflation and they have to keep full employment. So when there's weakness in employment, what that means is the Fed is more likely to think about a rate cut in the future, which therefore is good for mortgage rates, because when rates are trending down in general, all other rates kind of have to follow.
So it's almost like good news is bad news and bad news is good news.
Yeah, for sure. In the world of economics, bad news can often be great for mortgage rates.
Huh.
Yeah.
That's tough for some people in the
Yes.
economy, for sure.
Yes, for sure.
Huh. All right. The other thing I want to bring up, because what you just said, I kind of feel like a little bobblehead. Like my head's just like spinning. But there's more to it. Like what, and this is opinion, right? Like
Sure.
what would you see? Like, let's say things go in a positive direction here going into the fourth quarter and hopefully going into 2026, and those rates do continue to creep down. Are we going to have like, is it just suddenly going to be like 4.5 again or 5% interest rates on the dot? Or do you see it more just like, I mean, what do you see, I guess, is the question.
That's a great question. I mean, everybody, of course, wants to know what's going to happen and when they're going to drop, and things generally, I don't think we'll get into the 4s. I think we'll get into the 5s, and there's a lot of kind of complex reasons for that. That I think that's generally the common feeling in the market, is that we'll land in the 5s, but it's going to take us a while to get there. And I think there's a few things that are at play that get really sort of economically technical, I guess. The Trump administration is doing some things like they want to reduce. So every time a bank loans money, there's a certain capital reserve ratio, which means they have to keep so much money in the bank based on what they loan each day. Okay. So this is common between Republican and Democrats, is to raise or lower that, whatever that amount is or that percentage is. And coming out of 2008, it was set higher because they felt like that was part of the reason we had so much trouble with banks, is their reserve ratio wasn't high enough. So the Trump administration wants to lower that a little bit, and that's in process to happen, and will probably unwind in December-ish. And that's going to free banks up to be able to do a lot more things with the money that they are holding. They can't really go invest it in the stock market, but they can put some of that money into treasuries and bonds and mortgage bonds. And again, when you have activity into those instruments, it tends to drive rates down. So that's another piece that's going to take months to help mortgage rates get better. So I think that we'll see, probably a couple cuts this year by the Fed, and we'll see them start drifting lower. There's the idea of paying points. So people often don't understand what 1 point is 1% of the loan. Okay. You can pay up to 3 points on a primary residence to buy your rate down. Okay. So you'll be able to probably buy your way maybe into the 5s on a lot of loans if you want to do that. But probably loans without points will move into the lower 6s. I'd say in the next, between now and spring would be my guess.
Okay.
Yeah.
That's actually reasonable.
Yeah.
It seems like just a little bit more moderation.
Yeah, exactly.
And I can kind of see that too, like, because if they did drop really dramatically, all of a sudden home inventory depletes and we get back into this buy and demand situation, which was wild, of course. We went through 2021, 22 together and going into 23. So, I actually like kind of a normalized market, but those interest rates being in the 7s has definitely slowed things down.
For sure.
So
the benefit, I think, of rates being high for so long is, a lot of people complain about affordability, but affordability is actually, that gap has narrowed. Yeah, and that's my concern is if rates go down too fast, is we're going to see that widen again.
Yeah.
Right. We're going to see home values tick up a little bit more. It's interesting right now. I mean, home value, people feel like they see a lot of price reductions on the MLS, and doesn't necessarily mean we're in a declining market. I think there's this huge disconnect right now, and you could answer to this probably.
Yeah.
This disconnect between buyers and sellers. Buyers know that there aren't a lot of buyers, and so they think they have a lot of leverage with sellers, and a lot of sellers, I think, are somehow still living in 2002 or 2022 during COVID, right, where they feel like they can demand a lot for their property. And they might even overpaid for it a little bit a year or two ago. And there are places in the country that values have declined slightly, not a lot, but in Montana is one of the states that is. I think it's a great opportunity, and the smart buyers right now are picking up on that.
Yep.
I've talked to a lot of them where they're like, wow, it seems like I have a little bit more leverage right now. Some sellers are being a little more negotiable, and they're also ahead of the curve, because just imagine if rates dropped under 6, like it would be a frenzy.
Well, there's tons of people that want to buy, and I mean, the thing of what I look at too is that even though we had those price reductions and stuff, like the people that call me a lot, actually in the past year, have been like a lot of investors, people that are experienced, or people that have bought multiple houses. They know what's going on at the moment. So, I mean, my crystal ball thing right now is that I feel like we're kind of in that bigger dip at the moment, and it could last into 2026, but it's going to get more active, and those days on market are going to go down. And that's the big thing, is I don't think it's going to be, our average days on market right now is bouncing between 90 and 100. Days on market, which 90 days, I've said this before, is, basically the tipping point of a buyer to seller market. So we've had like buyers for a second, sellers for a second, and even though the inventory is a little bit higher, I mean, I've had some clients looking for homes right now. And if you're looking over $1 million to $1.5 million, there's more than double the inventory in Flathead County than there is under $1 million.
Yeah.
So like you look at those like $800,000 to $900,000 or $700,000 to $900,000, there was like 75 active properties opposed to 188 over $1 million.
Yeah.
So we're really seeing those price points in those upper ones going down more dramatically.
Yeah.
Now, if someone bought a house for 1.5 in 2022, they might not be making money on selling it right now.
Right.
They might lose some money. So it's a better idea to hold that unless you've had it for many, many years.
Right.
Right. So I do see that on a regular basis, but I also look at, in our past market reports, we're talking about infrastructure and these people pouring money into Flathead County. And I'm like, someone knows something with more financial status than we do, even, and then the investors are kind of coming in and doing that. So I really do truly think like it's a good time to buy, and it'd be great to see like if like someone signed up with you for a loan, right? And all of a sudden right now, maybe the interest rates would even go down a little bit more before they had to get locked in.
Yeah, exactly.
So like, it's like, I mean, right now there's this kind of tipping point in the Flathead. It's also school started. And so like, there's usually a little bit of a buffer until probably the 3rd week of September, but we usually, 4th quarter is busy.
Yes.
Yeah. I mean, I'm seeing it, like it's slowly going to pick back up again.
Yeah.
It's my thoughts, but
same for me. 2nd and 4th quarter is always busy. I have clients that, for the most part, if they're going under contract now, I'm having them float because the market is anticipating a 0.25% cut at the next Fed meeting.
Okay.
About 10 days ago, the Fed met in Jackson Hole, which is a annual event. It's not one of their scheduled policy meetings, but they talk about what their kind of intent is for the rest of the year. And Powell did signal that we're going to have he's comfortable with a 0.25% rate cut in a couple weeks. So that's pretty high likelihood that's going to happen. So that'll be great.
So I guess going back to kind of what we were talking about before, I mean, we had a little bit of an interest rate, drop, like around 2 weeks ago. So does that mean we might have another one after that, or is it already
again, I'm trying to remember exactly what that was a result of. I'm pretty sure that was a result of a jobs report.
Okay.
And the other thing you don't hear on the news is, yes, we had a drop, but they also drifted upward since then for about 5 or 6 days.
Okay.
And they don't report that on the news, right? The only thing you hear is like bigger pieces, and then they've kind of come back down again. So if you look at a candlestick chart or a chart on rates, they're at the lowest point they've been this year. They're at the lowest point, I think, in about a year. We had a drop last September that was significant.
Yeah, that was a big rush for a second there. I remember it.
Yeah, for about 3 weeks.
Yep.
Yeah, because we started a bunch of
I had a great
refis
fourth
and then
quarter
rates
last
went
year.
away. Yeah.
Because of that, I know. Everyone got locked in.
But yeah, so the cool thing, if you look at those charts, like they're down in a range now, and if they can hang on there, meaning if we don't see big inflation numbers, right? So if we saw big inflation, the Fed would put the brakes on.
Okay.
If we see all of a sudden a lot of really strong jobs data, they might put the brakes on. Those are the two things that could get them to not cut. But we had PCE out last week on Thursday. It was supposed to be slightly high. It came in slightly high. The market was expecting it, so really didn't react. Jobs report came out on Thursday as well, and it kind of you really have to read through the lines. Like when the press gets a hold of it, it's almost worthless when they just give you the headline, because there's so many ways to like, you really have to be able to read into it and understand. So let me see if I can remember the jobs report. Is that there was only 200,000. Basically, there's a lot of people that are no longer available to get jobless benefits, and so they're not being counted now, because in most states you can only receive jobless benefits for 26 weeks. And so a lot of those people have fallen off. And since COVID, you have a lot of people that are now like gig workers or 1099 independent. They're not eligible for job. So if their employer, like if you're a traveling nurse and all of a sudden the hospital doesn't need you anymore, you're out of a job, you don't get to go file for unemployment. You're not part of the data.
Because you're a 1099er?
Right.
Got it.
So they think that there's more of that. And so therefore the jobs report that came out last week is maybe a little weaker than what it appears, just because of some of these holes. There's also like this huge discrepancy, and there's monthly, the Bureau of Labor Statistics comes out with numbers, and those have sounded really strong for quite a few months. But then there's a quarterly report that comes out, and it's way more thorough jobs report. Like they interview and get hard data from way more businesses than the monthly BLS report. And the quarterly reports revised downward, like for last year, I believe it was almost 1 million jobs. So the BLS reported we had all these new jobs, but the quarterly report said, no, we don't. Actually, by the end of the year, we had something like 900,000 fewer jobs than we thought we had.
I remember talking to you about that last year.
Yeah,
and it was just like all over the board, and like everywhere, like they're lying, but it was just like it was data that hadn't been really dissected yet.
Yeah. So the Fed understands that. Mm-hmm. I hope.
Okay.
So because there's a bunch of voting members every time they go to cut a rate or raise a rate. And it's interesting hearing their opinions, because a lot of them, hardly any of them have any actual real world experience. They're all like lifetime government employees. And so what they focus on sometimes is really like off the mark. And some of them are known for certain things, like, they maybe have a good sense about one piece of the economy, but not about the rest. And some of the comments, and they all make speeches here and there at different events that sometimes can influence the market. And they might make a comment about something that's just seems like really uneducated. You're like, wow, you're a Fed governor.
Yeah.
You need to learn more about how that works, So it's fascinating to me how, like those BLS reports, how erroneous they are, and yet that's what's driving mortgage rates and decisions in our big decisions in our
That's
economy.
a big deal.
Yeah,
I mean, super affecting the economy.
yeah.
Ugh.
So
See, and this is actually the reason, like, I'm just honest, everyone watching, like, Ed teaches me a lot.
Yeah,
Like, I
cool.
love hearing him talk because it's more information that I've gotten from any other lender.
Yeah.
You know, when it comes down to it, like dissecting deep into that, giving an understanding, you
Yeah.
know, and your opinion. Like, I'm not going to sit there and hold it to you. Like, who knows what's going to happen? I've listened to tons of
Right.
people that said we were supposed to be a minimum of 12.5% up this year. That was the game. That was what everyone was saying in 2025.
in values,
Like, just no, just in sales volume
Oh,
for like
right,
for real estate
right.
and everything else. Like, hey, that's
Yeah.
the base mark. You should try to go for 25% up. And I mean, honestly, as of right now, I'm down.
Yeah.
And I'm still a top producing agent. Like, I
Yeah.
mean, our team does really well in volume. We're not necessarily down that much, but more than normal.
Right.
And so, you know, I mean, it's like these type of opinions. I like to dig deep into the education of it.
Yeah.
Thank you very much for
Yeah.
for being here. Any random other comments that you want to share with the community here?
Let me look at my slides. The one thing I
We don't
see,
look at.
so the one thing I would like to share, at least briefly,
Flip
is
them up.
we can flip on that one, is the Case-Shiller home price appreciation.
Yeah.
A lot of people are sitting out there waiting for a while there, people were waiting for rates to drop or values to drop. Neither of those happened. So now some of those people have decided, okay, I'm buying, right? And I think this kind of goes out to, I guess, first-time home buyers or people thinking about changing a home, needing a bigger home or whatever. Is I think it's, if you're ready for whatever that new payment is, now that is the time to buy. We talked about it earlier, just, you know, potentially what will happen when rates come down. It's already noticeably busier right now than it was 2 months ago.
Yep.
And, you know, this Case-Shiller home price appreciation is really cool. You can go back, they measure the top 20 cities, and then there's national numbers. I kind of feel like Montana personally follows the national numbers. And really, there's not that many down years. And if you look over time, values increase. It's pretty impressive. And if you look at the statistics on the portion of people's, if you compare homeowners versus non-homeowners and their overall wealth, hands down, people that own homes are wealthier by a huge amount. I wish I had the stats on that for you today. If you look at just any way you slice those numbers, home ownership builds wealth, and it's the easiest, fastest way to do it. If you're renting and you want to own a home, you should really reach out and talk to someone and start finding a way.
Well, I'm been putting my money where my mouth is, and Ed and I have been talking. To be determined what might be happening with the Baumgarten household, but we'll see.
There we go.
No, and I mean I agree too. I've seen some people really win. The reality is I have seen some people lose too.
Yeah,
and that was
sure.
but it was years ago when it comes down to it. And as long as you hold for the right timing.
Yeah.
But things happen, you know, there's death, divorce, babies, like people need to always move into something different. So anyway, Public, Flathead Valley, Ed Nissen here. Thank you so much for your time, my brother.
Thank you.
I really do appreciate it. And we'll be talking soon. And thanks for listening today.